On this episode, I have the pleasure of welcoming back Sven Carlin. Sven has had an amazing career, having been an investor for more than 2 decades, studying a Ph.D, analyzing stock market risk, working in data research, running his own investment research platform, and he also has an amazing YouTube channel. So, Sven, thanks so much for coming on the podcast today.
Thanks for having me. It's my pleasure.
No problem. I'm looking forward to speaking. So can you tell us a little bit more about your investment journey and sort of, I guess, what attracted you to investing?
When I was 18, all I wanted was to be free. So I looked at having 1 million so that I can have 50,000 of dividends and then live a free life. And one of the ways to do that was through owning businesses. So I bought some businesses, got the dividends, and from there it just started. One by one owning, and then the first 2000s emerging market boom happened, made a lot of money there, and I got hooked, and since then I'm an investor.
Yeah, it's interesting. They say it's very important about when you start investing. So I guess if you started in 2007, 2008, and then it crashes, that might have scared you away. But the fact you were at a pretty good bull run, it's probably attracted you to it.
Yes, and also I invested for different reasons. After a crash like 2000 to 2002, people were not looking at stock prices going up. People were looking at fundamentals. And I invested on those fundamentals. So I stuck to being a fundamentalist for the last 2 decades.
Yeah, okay, that makes sense. And then I guess what attracted you to really good companies? Was it just you kept doing more research and then you sort of understood that that's the way to invest, or was there something else?
Well, as Warren Buffett says, you are born a value investor. So I wanted more certainty in the investments I am looking at because I cannot predict the future. I can only look at what is there. And then I want the highest degree of certainty when it comes to my investments, that those lead to my financial goals. I'm not gambling on things. I'm just researching. And the more research you do, the more interesting things you find over time.
Yeah, it's a great point. I'd be interested in hearing more about your research process, because it sounded like I've listened to a few of your podcasts, and it sounds like you just basically analyze. You might look at one market, analyze every company in that market. So can you tell us a little bit more about that process?
So when I started 20 something years ago, I come from Croatia, and there was 2000, that was 2002, and on the market I think there were about 50, 60 names, and I was looking to find the best businesses to invest in that lead to my goals. And from day one I simply looked at every business that was available on my local stock market, and since then I just keep doing that, look at every business one by one, because it's not just about finding something. Every time you look at the business, you learn something new about something else that might come in handy somewhere down the road in the future. So I really like to go through the lists. As Warren Buffett says, start with the A's, and then you simply start accumulating that knowledge that over time leads to good results.
Yeah, it's a great point. And what does that look like? Is that just looking at the income statement? Is it going deeper, or is it just sort of very high level, and then you might see something that interests you and then you'll keep
I think it
researching?
depends also on the business. What are you looking? Everyone has the numbers. We all have the numbers today. The data is out there. You can run a screen, and everybody has the data. But then you have to go beyond those numbers to understand the story and how the story is connected to that data. Because if the data and the story are mispriced, then it might be interesting. And perhaps the most interesting thing to look at is the market looks at short-term things. And if you look 2-3 years ahead, then you can see mispricings because the market doesn't want to think 5 years ahead. And if something will happen 5 years from now with a higher degree of certainty, some new investment, some new plant, or something like that by a business that will lead to higher cash flows, that's often not properly discounted by the market. And the only way to do that is to really look at the data and then also at the story, connect it, and then go forward.
No, definitely interesting. So, what I guess what attracted you to value? You mentioned at the start it's sort of more to do with predictability or just being able to, yeah, I guess go into the numbers, predict cash flows, and go from there. Versus growth, which is I guess more high growth.
Well, there always people talk about value and growth, but growth is an essential part of value. I'm also always looking at, okay, how much can this growth, this business grow over time? And then you calculate also the growth and the value that's already there. The only difference between value investors, we want growth with a little bit more certainty than just growing for the sake of growing, also profitably growing, compounding, so scaling the business. So you always look at growth, but with more certainty. And perhaps something that differentiates value investing from everyone else, you might also want to get all that growth for free. For example, people look at Apple now, the P ratio is 40, and everyone is looking at the growth from Apple Intelligence Service and this and how to price that growth. 9 years ago in 2016, Apple was priced at a P ratio of 10 with 30% of cash on the balance sheet compared to the stock price, because everyone was thinking this company, the business will be flat for the next 2 years. And then you could get all the Apple growth that happened eventually for free practically. So that is always the things that we are looking in the markets.
Yeah, it makes sense. And is there I guess can you go further into your? I know you've talked a little bit about how you'd look into a company. What would be the next step? So say you find a company, you say, okay, there's a disconnect here. What would be the next step for you to maybe push you on the way to potentially investing?
First, I usually write a report down if something is interesting, because when you write something up, write a report, which I always do for my research platform, then you can understand better the risk and reward of a potential investment, compare to the sector, whether there is a positive structural tailwind. I don't know, population growth helps, because you always want to invest in those sectors that have positive growth ahead, because even then, if you make a mistake, the positive growth will save you. So you start at developing that story, and then over time, when maybe sometimes a year, 2 years pass, and you follow, you look at conference calls, you look at the past conference calls, what the management said, what the management did, what actually happened compared to promises. And then you start understanding the management, the goals, the business, how it compounds. And that is something that you can say, okay, now I know that business. And then depending on the price, you can consider investing in it.
Yes, it's quite a long process. Is there any times where it could be shorter from your perspective, or is it normally no? You have to really understand the company well before
It's
investing.
better to understand the company, because the market will always give you surprises. And if you don't understand the company and the stock crashes for whatever reason 25%, you're in panic. So it is a process, and you need to give it the due time, the proper time to understand owning what means owning that business. And when you have an ownership perspective and you know the company well, everything is different.
Yeah, I think I listened to one of your other interviews where you said you might follow this company for a few years. Once you decide to then buy the company, you might buy a very small percentage for 6 months or so to then understand from an owner's perspective. Is that still the case?
One of the best value investors out there, Walter Schloss, used to say, you need to own a stock to know the business, because without owning, you cannot really understand the correlation between the business, the stock price, and what are the opportunities the market might offer you. So I have a small diversified portfolio on my research platform where I own about 17 positions now. And whenever something starts to get interesting, I put it there and then follow it each quarter with news, with the quarterly earnings. And over the years, this knowledge about the business compounds. And then down the road, okay, now is the time to bet more. Now is the time to forget about this business. And the more you know about the business, the easier it makes to invest in it.
Yeah, it's a great point. And what are the key things that I guess you're looking at businesses? I know you've talked about there's a catalyst, there's a disconnect. Is there any, I know Warren Buffett's classic for moats and, competitive advantages and all these other aspects. Do you have sort of key frame things that you're looking for in businesses?
The more the merrier. Of course, everybody wants a business with a moat at a low price, scalability, growing at a certain rate, low competition. Everybody wants that, and we always look for that. Great management, assets, margin of safety, you name it. So we always look for something, but of course, perfection is hardly ever to be found, but we strive for it. And then you compare what you found with the price. And then if what you compared with compares well with the price, what you found compares well with the price, then it can be an interesting situation to invest in. It doesn't have to be always a beautiful business.
Yeah, it's a great point. It's also about the valuation and what other people value it at. But then I guess, is there any point where you would look at maybe it's a cheap business, but you still wouldn't invest in it? Because I guess some industries, there's reasons for it to be cheap.
Some industries have, but then you look, okay, always ask yourself from a value investing perspective, what can go wrong? So if I invest now, what am I getting paid for the investment? How is the business delivering value to me? What can go wrong? And all those industries that always seem to be cheap, you look at things, for example, I just look at the shipping company, Danaos. It has a P ratio of 3 now and a 5% dividend yield. Everything looks good from a fundamental perspective. And then you look a little bit at history, and practically the company went bankrupt twice in the last 15 years. And then you understand, okay, that's why it is cheap, because that's a reoccurring risk with shipping. You have these cycles, and then you have to understand how these cycles work. But you never know. Maybe sometimes you look at something and you understand, okay, this is really a good time to do something, and then you might take some action.
Yeah, I guess that's the benefit of following a company for a longer period. You can see those issues and
I have a list of about 25 businesses that I follow more closely now. And then depending on the cycles in the market, that goes to other sectors, and practically 50 that I've been following for the last 5, 6, 7 years. So I know them, and that's enough. If I get 2 opportunities per year to invest in something good, I'm a happy man.
Yeah, it's a great thing. And what does your portfolio look like? Maybe, not the names, but I guess, your concentration, the amount of companies you have. How do you sort of look to construct that?
So I have 3 levels of portfolios. So we have the covered stocks, then I have the diversified portfolio, which is it is a money portfolio, but just a small amount, just to learn more about how the businesses work. Then I have a model portfolio for those that need, let's say, 5, 6 investments diversified. And then my personal portfolio, at the moment, I have 1 business, for example, just 1, because that's the only low risk, good reward that I can find in this market.
Oh, wow, that's pretty concentrated. So,
Yes.
do you would you be willing to talk more about that business, or?
I cannot give you the name, but I can just say that as I'm looking at the global environment, as Warren Buffett always says, if you have from 1 to 20 investing opportunities, then I'm always thinking, why wouldn't I put most of it in the best investment opportunity rather than putting it into number 5? And then again, perhaps something that is misunderstood here, I invest on a monthly basis. So I invest. And if I invest, I don't know, I have invested X amount into this business now, maybe from next month there will be something else that's interesting. And then over the next 2 years, I just invest in something else. And then 2-3 years down the road, we are already at 2. 5 years down the road, we are 3 businesses. And so you build a portfolio of great businesses at great prices, and then you don't have to think much more about it.
Yeah, it's a great way to put it. And then how would you go about, exiting a position? Because I guess especially when you're only in one position, you need something. It'd take a lot, and you probably need a better opportunity to come along.
If the market revalues the opportunity, and then I say, okay, now if the price goes up, the returns are mathematically lower and the risk goes higher. And then you compare it with other opportunities, and then I'm happy to rebalance. If there is something, I don't know, 50% better than what I own, then I rebalance. And then when to sell a stock, I often tell people, when you need the money, and if you feel something you own is overvalued, overpriced, or priced at a level that doesn't really lead to your goals, you feel it's too risky, well, investing is there to make your life better. So sometimes it is smart to just sell it and do something that enriches your life financially by selling something that made you good.
Yeah, no, that's a really good point. So I'm guessing, as you're saying, it seems like you think the markets are quite, and obviously this is a broad term, there's going to be good companies, but the markets are quite overvalued currently, and they seem to keep going up. Is that what you're really seeing globally?
I'm not attracted, let's say, by the current stock market, S&P 500. I constantly, daily look at businesses constantly, but everything seems, for me, fairly or richly priced, which means I don't like the risk for the reward. The S&P 500 has a dividend yield of 1.2%, which is insanely low. So nobody is getting rich on that, but there is this automatic investing, and inflows keep going on because stock prices keep going up. Stock prices keep going up because inflows keep going on. And for now, there is no sign that this will turn, even if there might be, I don't know, recessions, interest rates higher inflation that forces the Fed to push rates higher, things like that. Those things are always around the corner, and those are the risks. And that's why I don't like investing in just like the general market, because I consider it extremely risky now for the very low reward.
Yeah, it's a good point. And then you mentioned dividend yield. Do you also look at, I guess, total distribution, so including buybacks? Because it seems like that's the way that a lot of companies have sort of moved their distributions.
Yes, but at the end, buybacks should be there to grow the dividend distribution per share. If the dividend distribution per share is not growing by the level of buybacks, then buybacks are destroying value. And if buybacks are done at a P ratio 30-40, then buybacks are, as to quote Warren Buffett, stupid. So he sold Apple because Apple is doing stupid buybacks. And it is one thing doing buybacks at a price that I would like buying too. And the other thing is doing buybacks just to push stock price higher, and higher, compensate management that then gets shares that you buy back, and then they sell it in the market and things like that. It's a very vicious cycle, the buyback cycle at the moment.
Yeah, the incentives are sort of skewed towards that, as you said. And I think it is a really interesting thing, as you said, that I guess the best allocation of capital would be, it could be dividends, or it could be buying back when your stock is undervalued, and then special dividends when you're sort of overvalued. Like there's hardly any companies that sort of do that.
The thing is, if I am a CEO of whatever company, except Warren Buffett with Berkshire, because Buffett's goal is not to push the stock price higher. Buffett's goal is to compound equity at a high rate. So only Buffett can say, no, the stock price is too high to do buybacks now. Every other CEO, if he would say, oh no, the stock price is too high, he would get fired immediately. So it's really impossible to put yourself into that position and say, oh no, we're going to pause buybacks because the stock price is too high, which would immediately crash the stock, and then you could pack up your things and get fired, probably a few losses there.
Yeah, and I guess a lot of the a lot of those big companies, they tried not to do it for so long. So I guess you look at the Googles, the Apples, they had hundreds of billions of dollars of cash that just kept building and building and building. And I think it got to the point where they just couldn't find ways to spend it, which is the issue. And then, as you said, buybacks might not be the best way. There could be other ways. But
at some point, yes, buybacks are smart, but nobody now has the guts to say, okay, we're switching to dividends. So because it's counter day job. Every CEO is a salesperson. They need to sell the stock. They need to make money for shareholders by pushing the stock higher, which is different than by creating more value through equity.
Yeah, it's a great point. So there's been a lot of talk, I guess, from people saying that value investing is dead. It seems like growth investing has sort of outperformed, at least generally over the past decade, at least. Do you have an opinion on that? Is it just that people are looking at the wrong companies, or what are your thoughts?
I think that first you have to look at the European stock market index has been flat for 25 years, so flat. And then people look just at one index, the S&P 500, that over the last few years has done 14%, over the last 7 years have done 14% per year, which is the most remarkable bull run since compared to the 1920s. So first we have to compare apples and oranges here. So you are taking the best bull market in history and then comparing it to everything else. And I'm happy to hear that value investing is dead, because the difference between value investing and everything else is that value investing works in whatever environment. The P ratio of my portfolio is 10. The P ratio of the S&P 500 is 30. Maybe it can go to 50 and I will keep underperforming, but I'm happy underperforming. And that would actually be my hope scenario, that the S&P 500 does 20% per year for the next decade, and I do my 15%. Let me know where I should sign. There are just risks that nobody can predict whether those will materialize or not. I will go for my returns with more certainty, which is value investing.
Yeah, as you say, it's more the risk-adjusted returns, which is what you're aiming for.
You cannot never know what the risks will be and how the risks will materialize. But if you just look over the last 45 years, since we have had interest rates just going down, down, and down, and I still consider them very low because the expectations are for more zero interest rates, or 2%, which is nothing. So valuations went from a P ratio of 7-8 to the current 30. So just in that valuation expansion, you have a 4x in the market. If we go to average historical valuations of 15, on average interest rates of, 5% for the 10-year treasury, then the stock market will go down 50%. And then it would take more than a decade just to come to zero positive returns, which then explains the risks. And I'm not going to risk investing in something with a 1% dividend yield when I can find globally investments that give me 10% or more.
Yeah, it's a great point. So is there any, maybe not talking about the company you're invested in, but is there any in the other portfolios that you're sort of quite interested in at the moment, that you've been analyzing quite closely, that you can talk about?
The last sector that I've been looking a little bit deeper is food. And I've made recently a few videos, not about food, but about food brands like Kraft Heinz, Mondelez, things like that are also cheaper, but that is more a brand question. So those big brands from the last 20, 30 years are losing their power. But in general, food stocks have been overlooked by the market. And I can give you an example for Archer Daniel Midlands. If you look at the food cycle, everyone expects weaker food prices, uncertain prices in 2025, and therefore the stock went from 100 to 50 where it's trading now. But if you look at the long-term cycle, it's now trading at the free cash flow yield of 10%, 4% dividend, usually the 3-4% inflation, food inflation growth over time. So you already have a nice 10% yield from something that is more or less certain, because usually I see that people eat every day. And I think that despite AI and things like that, people will continue eating. So that is the value investing way.
Yeah, and I guess the risk is there, sort of commodity exposure and the potential increase. I know sugars, sort of, and coffee, these type of commodities have had quite large increases, but then ideally they'll sort of go up and down. They'll sort of balance each other out.
Those are a little bit more specific, but if you look at corn, at things like that, at the crushing margins, at the global distributions, there are always ups and downs, and the market always thinks, okay, now prices are down and prices and things will remain like that forever. That's usually not the case, and that gives us value investors, if you want to have something nice like food exposure. Archer Daniel Midlands is the company that has increased dividends for the last 50 years. So, and they plan to continue to do that. They have all over the world, global population is still growing, more demand. So we have these positive trends at a free cash flow yield of 10% on average for the last 10 years, plus the growth. And then you say, okay, that's already something interesting.
Yeah, it's a great point. So I know what you mentioned, you started sort of looking at Croatian stocks when you began your career, and I think you mentioned before that at the time it was a frontier market because it was sort of the economy was just growing. So are there any other geographies that you're looking at? And I guess if they're frontier, how do you sort of go about?
I'm looking more now at the risks, and I was born there in Croatia. I live there, so I know the market very well, which is now overvalued. But to go into a frontier market, you really need to know it. You need to speak the language, understand the legal implications and things like that, which is very, very hard. So I try to stay out of markets where I don't speak the language, and I try to stay out of markets where I don't understand what's going on with the business. Some businesses now have everything shown in English. If you go to the Philippines, for example, things like that. So everything is made easier then. But I'm not going into, I don't know, crazy markets.
Yeah, it's a great point. So Sven, thanks so much. We sort of talked all about your your career, investing, your strategy, everything like that. I feel like we've gone in all different directions. So my last question is, what is one message you want people to take away from our conversation?
Just to think at whatever you own, whether it is leading you towards your financial goals from, let's say, a fundamental perspective. How is that business that you are owning creating wealth for you time over time, or will create wealth over the years compared to the price you are paying? Sometimes it's better to pay your 6% mortgage than to risk losing 50% on something crazy.
Yeah, it's a great message. So thanks again for your time. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
They can just send me an email at investwithsven@gmail.com.
Perfect. I'll put in the description below, but thanks again for your time.
Thank you very much.